So Section 2, it deals with still financing, of course, but getting more in depth about the different types of loans that are available to people and how we're going to differentiate those different loan types from each other, and what are the differences in loans. And so we're really kind of taking a deeper dive here into not every loan being the same thing, because the truth is they're not all the same thing. They really do differentiate a lot, and the different types of loans that are going to be available is not going to be the same for every borrower. Different borrowers are going to have different choices available to them. That's the nature of the beast when you talk about financing. I mean, remember, a lender is giving, in many cases, hundreds of thousands of dollars to these borrowers. And the lender has to feel reasonably comfortable that the borrower is going to be able to repay that amount of money. And so not every borrower is going to be equally capable of doing that or equally qualified for all the different loan types. And don't forget, obviously, there's always the option of paying cash, but then lending is not always a straightforward path. You can borrow money from a bank. That's obviously the most common route that people take. But look at the second or third bullet point rather here. It says buyers can borrow the money from the seller. I'm going to read that again. A buyer can borrow the money from who?
The seller.
The seller themselves. Not a bank, not an outside third party, but that's a possibility. So you need to open your mind and realize there are all types of financing that's available out there. Now, when we borrow money from the seller themselves, there's really no different than taking out a loan from a lender, except the source of the money just happens to be the person we're purchasing the property from. We call that owner financing. You'll also see that, sometimes referred to as the seller taking back a note, because in other words, the seller brings the property to the closing, and instead of taking cash away from the closing, the seller takes a note, a promissory note away from the closing that the buyer will pay them. Another option is buyers can assume loans that already exist. So we're going to talk about several different paths to borrowing money. We mentioned earlier today the idea of an assumption and what an assumption is, what an assumption means. This is a situation that happens when a buyer / borrower takes over the existing promissory note rather than going through the process of obtaining a new loan from their own lender, rather than going out and shopping around and, applying for loans with lenders on the marketplace. The borrower is simply saying to the seller, hey, I would like to purchase your property, but I would also like to take over your loan. So let's think about that for just a second. When we talk about a buyer who's taking over responsibility for somebody else's loan, I think people make that more confusing in their own mind than it needs to be. That is entirely separate from the purchase, folks. What I mean by that is, just like any buyer in any situation, very rarely is the buyer or borrower borrowing 100% of the property's value. Usually the borrower is making a down payment. Usually the borrower is borrowing something less than 100% of the property's value. It's not going to be any different if they do an assumption. It just means instead of borrowing from a bank, they're taking over a loan that already exists. In other words, if I agree to pay the seller $300,000 for the property, and the seller has a mortgage note for $200,000 that I'm going to assume. Am I paying $200,000 for the property, or am I paying $300,000 for the property? If we've agreed on a purchase price of 300, does the purchase price change just because I did an assumption?
No,
No, it
you got to
doesn't.
come up with that difference.
I've got to come up with the difference. I'm assuming $200,000 of debt, which means I'm going to pay the difference to the seller who just sold me the property. At the end of the day, folks, the assumption doesn't change anything from the seller's perspective. Sellers don't care about assumptions. Assume it, don't assume it. Doesn't affect most sellers. The vast majority are not willing or able to impose their will because they just don't care about what happens with regard to an assumption. They're not interested because from their perspective, it's exactly the same thing. It's all the same thing from the seller's perspective. But it does require permission from the lender. There is absolutely a requirement of permission from the lender, and therefore not all loans are going to be assumable. That's not an option in every situation. There are going to be times when the lender's simply not going to do it. But I want to ask you all a practical question, because it'll help you, I think, if you can bring your own self around to the answer, I think it'll help you understand an assumption. When would it be, I don't know, advantageous for a buyer to assume a seller's loan? Now, stop trying to think about how to be schemey McSchemester and you're going to qualify for a loan that you wouldn't ordinarily qualify for. I'm not talking about anything insidious. I'm not talking about somebody trying to qualify for a loan they wouldn't ordinarily qualify for. I'm talking about a well-qualified borrower who could go out and get any loan they want, take their pick, but they've decided to do an assumption instead. Why? What drives that decision?
Rate,
Interest rates might be lower.
Interest rate.
Interest rates. Specifically, what about the interest rates? Compare the two loans. Compare the assumption loan versus that person going out and getting a new loan right now.
right.
Loan
Lower rates.
interest rates might be higher if you get a new one.
The new one, they've shopped around and they found that interest rates on new loans are higher than the interest rate is on the seller's existing loan. And so since they can't borrow money at that rate, the next best thing is take over somebody else's loan who did already borrow money at that rate. Does that make sense for everybody?
Mhm.
Okay. And that's what drives the decision about assumption, but they're not all assumable. We'll talk about the ones that are assumable and ones that are not assumable. One of the most important factors that we deal with in lending is something called the loan to value ratio. The loan to value ratio, everything's about percentages. The loan to value ratio is all about how much of the value of the property can be borrowed. To what extent do we allow the borrower to borrow against the property? Do we allow them to borrow, half of the value of the property? Do we allow them to borrow 3/4 of the value of the property? Do we allow them to borrow the full value of the property? And different lenders and different loans are going to have different policies in that regard. Folks, the vast majority of borrowers are not borrowing 100% of the property's value. If you think about it, that is exceptionally risky from a lender standpoint. Remember, what's being pledged as collateral for repayment of this loan? What do y'all think?
Property.
Property.
Yep, the property.
The property itself. So if the property has been pledged as collateral, if Grant goes out and buys a property today, and he's paying $400,000 for the property, and he borrows $400,000, and he never makes a payment, and the lender has to foreclose, how much does Grant owe the lender?
The
Value
full-
of the property.
$400,000, right?
Right.
But Isn't it probably more than that now that they've tacked on penalties and interest?
Yep.
Mhm.
So now he owes maybe like 403. And oh, by the way, aren't they going to tack on like 10 or $15,000 in trustees fees when they have to foreclose?
Yes.
Yes.
So now he owes like 415, 418 on this property. Meanwhile, he just purchased it for how much money?
400,000.
400,000. And it's being sold now as a foreclosure. What do you think it's going to sell for at that foreclosure auction?
Less than 400.
That's bad
Probably
money.
less than 400, right? 370, 380, something like that. Well, if the thing only sells for 380 and we're trying to squeeze 415, 416, 417 out of it, has the lender taken a big loss on that property, even though supposedly they weren't lending more than it was worth? What do y'all think?
Yeah.
Yeah, they have. And so most lenders want borrowers to put some money down. That's where the idea of a down payment comes from. Now, as a math formula, this is how we calculate somebody's loan amount. We look at the market value of the property, which is either going to be what they're paying for the property or what it appraises for, whichever number is lower. So let me just explain what that means, because I know some of you freak out whenever you see something like that, and it's just not necessary. If Mandy's buying a property for 400 and appraises for 375, are we going to use the 400 or the 375 when we're calculating everything related to her financing of the property?
375.
375.
375. If she pays 400, that's her fault. That's her problem. And she'll have to come up with that. Here's the way lenders look at that. Lenders are only going to participate up to the point where the appraisal stops. And after that, if Mandy wants to pay $25,000 more than that property appraises for, can she do that?
Yep.
Yeah.
But she can't borrow it. Does that make sense for everybody?
Mhm.
Yeah.
She's coming out of pocket for that money. But she's also going to come out of pocket for more than that, because she probably wasn't borrowing 100% of the property's value anyway. Does that make sense for everybody? So
Yeah.
let's just map that out. Let's say the purchase price is 400,000. The appraisal comes in at $375,000. Oops, can't write today. $375,000. And let's say that Mandy has been told she qualifies for a 90% loan to value loan. Does that make sense for everybody?
Uh-huh.
So if we're calculating how much she can borrow, the question becomes, are we calculating how much she can borrow based on that number or based on this number up here? Which one of those numbers are we using to calculate how much she can borrow?
375. 375.
375, because the lender's
The
only going to
appraisal.
participate up to the lower of those two numbers. Does that make sense for everybody?
Mhm.
Yes.
So to calculate how much Mandy can borrow, we're going to plug 375 into this formula and multiply it times that 90% loan to value ratio. And if you do that math,
337,500.
thank you. That's a loan of 337,500.
500.
Here's what I want to show you though, folks. How much is Mandy paying for that property? What did she promise to pay for it?
375. Oh, 400.
$400,000. She didn't promise to pay what it appraised for. She promised to pay 400. Does that make sense for everybody?
Yep.
Mm-hmm.
But the lender is going to base their loan based on that appraisal amount. So if she borrows 337,500, guess what? Guess where the rest is coming from?
Out of her pocket.
Pocketbook, lady.
Her pocket. So she would have to put 62,500
65.
Mhm.
down to make that transaction happen. That's not what she was planning on when she made that offer. I can assure you of that. Because
I
in
thought you
her
were
head-
about to say, damn.
in her
Sit
head, she was thinking she's putting what, 10% down? Does that make sense for everybody?
Mhm.
By the way, if it doesn't, let me show you this. Does it make sense if I show it to you that way? that the higher your loan to value is, the lower your down payment is, and vice versa, that they're the inverse of each other. So
Mhm.
if you take out a 50% loan, how much are you putting down?
50%.
50%.
If you take out an 80% loan, how much are you putting down?
20%.
20%.
Well, see, Mandy in her head, she had done the math and she's like, oh, I'm only putting 10% down. Well, what's 10% of $400,000, folks?
It's 40,000.
40,000, right? So in her mind, she's thinking her down payment's 40,000, but then that appraisal kicked her in the rear end.
Uh-huh.
That big bad appraisal came along and jumped up and bit her because the lender said, hold on, Mandy now. As far as we're concerned, you're crazy, Mandy, and you're paying way too much for this property. Now you can be crazy, Mandy, and you can pay too much for this property, Mandy, but you're going to do it on your own dime, not on ours. Is that a fair statement for a lender to say?
Yeah.
That you can go as off the reservation as you want to, and you can pay as much as you want to for the property, but we're not participating in that craziness. We're basing our loan based on what the appraiser thinks that this property has as a reasonable value. And that's what lenders are saying in the current environment. How many of you all think buyers are finding themselves in this pinch right now?
Oh,
A
yeah.
lot.
Yeah.
A lot.
Lots of them, because they're in this battle where they're driving the prices up 10, 15, 20, 30, 50, $100,000 more than anything that's ever sold in that neighborhood. And the appraisers are coming in and now remember, appraisers are having to look at what's happened in the past to try to come up with a prediction of value. Well, if you're selling for $100,000 more than anything's ever sold for in that neighborhood, is it going to appraise for the contract price, or is it not even going to come close?
It's not gonna come
Come
close.
close.
It's not even going to come close. And when we do the calculation for how much that lender's going to lend, folks, they're going to look at the lower of those two numbers. They're going to look at the purchase price and the appraised amount, and they're going to say, well, we're basing our loan, we're going to be as safe as possible. We're basing our loan on the lower of these two numbers. Does that make sense for everybody?
Mhm.
Mhm.
Okay. And so the buyer's got to come up with the difference. You know, people ask me a lot of times, what is an appraisal? What is an appraised value? It's nothing in the world. And we have a whole chapter about valuation. It's nothing in the world but a professional opinion of what a reasonable price is for the property, given current conditions and given what we know about what's happened in the past. Now, notice I put heavy emphasis on the word opinion. Are different appraisers going to come up with different opinions of a property's value?
Yes.
Absolutely.
Of course they will.
It's an art, not a science.
Very much an art, not a science. I mean, one appraiser may look at in a neighborhood and allocate, $10,000 for a one-car garage, and another may allocate $15,000 for a one-car garage. And neither one of them is right or wrong, because at the end of the day, it's an opinion. But it's really no different than going to the doctor. Really, if you think about it, most of the time when you go to the doctor, you don't get a definitive diagnosis. You get a what?
Opinion.
Professional.
And an opinion.
Opinion.
You get now, it's an educated opinion, but it's still an opinion. And that's all an appraisal is. It's an opinion of what a reasonable value is for the property at that given time. And banks rely on that heavily because they know that buyers get carried away. Buyers do get carried away.
Oh, yeah.
Especially,
There's a big fear. If I don't buy it now, it'll be more expensive next week.
that's right. That's exactly right. And that FOMO, fear of missing out thing, it drives people, and banks know that. And so they're trying to protect themselves, and they do that with this loan to value ratio. So look at this just as just a straight up math question. It says a home is being purchased for $425,000. The buyer is obtaining an 80% loan to value loan at 5% interest. What is the loan amount? Well, anytime you're trying to calculate somebody's loan amount, you're going to look at the market value of the property. Now, I will be honest with you, on a test, they're probably not going to give you appraised amount and sales price. They're probably not going to be that complex. They're probably just going to give you one of them. And if they give you one, that's the only one you can use. Does that make sense for everybody? Okay. So in this case, the market value is $425,000, and they tell us that the bank is allowing the borrower to borrow a maximum of 80% of that. So if we do that math, and we multiply those two, 425, it's times 80%. Looks like $340,000 to me. What do y'all think?
Uh-huh.
Yeah,
Yes.
$340,000 loan. And now, one way to look at that is, okay, well, you're borrowing 340,000 from, so let's say I owe 425.
mhm,
And I'm getting a mortgage from BB&T for $340,000. Could I get a second mortgage maybe?
yep,
Sure. Maybe I get a SunTrust second mortgage for 20 grand. And then the difference would, whatever's left over would be my down payment. Does that make sense for everybody?
mhm,
Okay, so again, it's just this idea of you're just calculating what somebody is borrowing versus what they're going to have to pay as their down payment. And that's exactly the way you need to start thinking of the loan to value ratio. It is the opposite side of the teeter-totter
I love you, right?
from the loan to value ratio. The loan to value ratio is the amount borrowed. If that's 70, balance the teeter-totter out. What's on the other side of the teeter-totter? If the loan to value is 70%, how much are we putting down?
30. 80.
30%. If the loan to value is 60%, we're putting 40% down. If it's the 90% loan to value loan, the borrower's expecting
10%.
right? So they just balance each other out to total up to the 100% value of the property. You will likely see on the test a question about this word. What is equity? Now, equity can mean different things in different contexts. I mean, yeah, it also means like equality and same treatment, but that's not what we mean when we say equity in this context. When we're talking about this class and we're using the word equity in financing, what we mean is, and I admittedly will tell you, I struggle with how to explain this. You ever notice how the things that are the easiest for you to understand are the hardest for you to explain to somebody else? You ever like taken that thing that just comes so naturally to you and tried to explain to somebody else how to do it, and you just want to scream at them and shake them? This is that word for me, because I just don't get why people struggle with it. And so I'm apologizing to you in advance, because I've never really come up with a better way to explain it other than it's the difference between your debt and your value. In other words, if you were to sell the property today and pay off all the debt, how much cash would you walk away with? That's your equity. So it's at any given time, it's the difference between what you owe and what your outstanding value is of the property if you were to sell. So, in our example here, it says Janice owns a home she believes could be sold for $450,000, but she has outstanding debt of $210,000. Well, if you do the difference between how much equity is she left with, folks?
$40,000.
$240,000 in equity. I mean,
I just found a really good definition too.
could somebody easily sell their house for $500,000, but only have $30,000 or $40,000 worth of equity in it?
Yeah.
Of
Yes.
course, if
Yep.
you owe a tremendous amount of money. So you're always simply looking at the difference between the current value of the property and then what you owe in debt. Imagine you sold the property and you paid the debts off, and the amount of money that's left over, that's your equity. It's also another way of saying this is what the seller would net from a closing. This is what they would walk away with from a
It took me
closing.
a long time to understand, Travis, that this also is affected by the current property's value, not just what you purchased it at.
That
So
is
if it appreciates, you have more equity. If it depreciates, you're starting to go under.
That's exactly right. Equity changes on a daily basis. And the reason it changes on a daily basis is the market value of the property changes every single day. Every day is a new day when it comes to market value. Could a property sell for more today than it did yesterday?
Absolutely.
Yeah,
Yes.
could it sell for less?
Sure can.
Yes.
And so when you look at equity, equity fluctuates. Now, over time, if we look over a long enough period of time, what should a property owner's equity do given a long enough period of time?
Raise up.
Appreciate,
up.
raise,
Go up. And it
increase.
should go up. Let's talk about that. It should go up due to a number of factors all working in the same direction after a while. Am I going to probably be doing something on a monthly basis that's going to increase my equity even if nothing else changes?
Yes.
Making your payment.
I'm making a payment. And if I'm making a payment and paying the loan balance down, I owe less. So even if the property stays at the exact same value, do I have more equity every month?
Yes,
Yeah.
compared to the principal.
If the property stays exactly the same, I have more equity every month because my debt is a little bit lower. Does that make sense for everybody?
Mhm.
Even if I weren't paying off my loan, even if I had a loan where I wasn't making payments and my balance stayed exactly the same, do properties given enough time usually go up in value anyway?
Yes.
Yes.
Yes. And so that would raise my equity even if my debt level stayed the same. What do we hope is happening in a perfect world? We're paying the debt down while the value of the property is going what?
Up.
Up.
So shouldn't our equity grow faster and faster and faster as time goes on? Because we pay the
Yeah.
debt down and the value of the property goes up. So we should see that growth in equity over time. Does that make sense for everybody?
Mhm.
Yes.
Okay. Now, one thing to take note of, and we'll back up here. If I were to label one of these two sides of that teeter-totter with the word equity, which side would I put equity on? Would equity be on the side with the debt, the loan to value ratio, or would equity be on the side with the down payment?
Down payment.
Down payment.
Down payment. So on the day you purchase, your equity is the same thing as your what?
Down payment.
Down
Down
payment.
payment. But every day after that, your equity is going to change. It's going to be
Go
different.
up.
Every day, it hopefully go up.
Oh, yeah.
Hopefully go up. Okay. When we talk about borrowing money, it's important that you are familiar with this idea of something called a debt to income ratio. A debt to income ratio. Well, first of all, ratio is just a percentage. It's a comparison of two things with a percentage. Lenders are not nearly as concerned with what you've done in the past as they are with what they think you'll do in the future. And one of the biggest indicators that you will pay back somebody in the future is that you make enough income to be able to afford that payment. So one of the first things that lenders will look at when they're trying to qualify someone for a monthly payment for borrowing money is how much income this person has. That's number one. First of all, I mean, if somebody's trying to get a house payment of $3,000 a month as a public school teacher, you think that's probably going to be a loan that's going to be qualified or not qualified?
Not qualified. Not enough money to pay back.
Why? I mean, they might have an 800 credit score. Why would they not be qualified to get that loan of three?
Because they don't have
Not
income.
enough
They don't
income.
make enough money.
Because they don't make enough money to make a $3,000 a month house payment. Does that make sense for everybody?
Mhm.
At some point, it doesn't matter how good their credit history is if they simply don't have enough money coming in the door to make the payment. They do have to eat. And they have to get gas to drive to that school to teach.
Insurance.
So they've got to have some money left over for those other expenses. So basically what we're taking a look at is how much of somebody's income can they reasonably afford as a debt payment. Then we also have to take into account, and this is where your clients are going to make really stupid decisions if you are not careful with them. We also need to take into account how much other debt they have. you are going to learn to have a very tough love discussion with your buyers. Because if they show up for a showing in a new car, you are going to need to call 911 on yourself because you are about to physically harm someone. Because I will almost guarantee you that whatever loan they were qualified for, they're no longer qualified for if they just went out and bought a new car with a much larger car payment. Because one of the things that lender was taking into account when they qualified them for that amount was how much other debt they were already paying. Well, guess what? If they take on an $800 a month car payment, that's $800 a month they don't have to spend on a what?
House payment.
On a house
payment,
payment. And it will absolutely, folks, I cannot tell you how many people have found out on the day of closing that they're not closing because they went and bought a car. Because guess what the lender's going to do again on the morning of closing, even though they qualified you way back when, on the morning of closing, guess what they're going to do one last time?
Or you credit.
Requalify.
Credit again.
They're going to
Review.
pull your credit one more time. Or furniture, you're exactly
If
right.
anything, yes.
Anything, right? They're going to pull your credit one more time. And they see that $800 car payment pop up in there and you were already tight on payments. You don't qualify anymore. You're not buying a house that day. You better hope that's a nice Mercedes because you're going to be sleeping in it. That's called a debt to income ratio. It's called a debt to income ratio. It is this comparison of how much debt is somebody responsible for versus how much income. Just to give you some perspective, traditionally, the magic number is 36%. That's the traditional magic number that lenders feel very comfortable with a borrower who is not spending more than 36% of their income on debt. That sounds like a lot, but
That's not enough.
really gets eaten up very quickly when you start to think about all these other payments that people might have. So let's just show you just with math. Not that you're going to have to do this as a math question, but I just want to show you as an example. Let's say somebody has an income of $75,000 a year, which is a nice income. Okay. So or we'll just say 72. That way the math works out evenly. $72,000 a year in income. Everybody with me on that so far?
Mm-hmm.
Yes.
If we divide that by 12, what we get is they're making $6,000 a month.
A month.
And what did we say was the magic sort of number that lenders would use to qualify you for?
36%.
36% of that. So if we take 36% of that $6,000, most lenders would say you qualify for $2,160 a month. Here's the thing though, and this is what I want you to pay attention to. That's not the house payment they qualify for.
For everything.
The total debt payment. So let me just show you something. They bought that car with that $800 a month payment. Guess where that $800 is coming out of, folks?
2160. So they'd be with 1360.
So now they've only got $1,360 they can afford for a house payment. Does that make sense for everybody?
Mm-hmm.
Oh, by the way, I forgot to mention, they also have a couple $100 a month in credit card bills. Guess where that comes from?
And a personal loan.
Right out of there. And, you know, they might have other debts. They might have student loans, right? Somebody that's come out of college, they got another couple $100 a month in student loans. There's another 200. Could that $72,000 a year all of a sudden turn into somebody who can't even afford $1,000 a month house payment?
Mm-hmm.
Yeah.
Real fast. Real fast. Alicia, we use, Alicia says, isn't that gross income? And that's exactly what they use, Alicia. They don't use after-tax income. They use gross income to qualify you. Is everybody seeing how that works as far as qualifying buyers and borrowers go?
Mm-hmm.
They're looking, Because basically what they're looking at, and that's why the percentage is low. That's why it's 36%. Because if you think about it, with the remaining 64%, they got to pay taxes, they got to eat, they got to get gas, they got to pay their electric bill, they got to pay for their cell phone,
Amazon.
clothes,
Car insurance, that's
car
really
insurance,
high.
all of that stuff. So it gets tight quickly when people have these big monthly debts. But that's what we mean by a debt to income ratio. Are we all okay on that?
Just note of caution, be careful what people are calling income, because they think they make a bunch of money that they don't really make. So you really need to work with a qualified lender.
Oh, you do. And here's what I would add to Elizabeth's statement about what the money they think. How shall I put this lightly, folks? The lender does not care about your opinion about your income. The lender cares what you have reported to the United States federal government. And so if you are someone who does everything they can to minimize their tax burden on a year-to-year basis by taking bunches of tax deductions, even ones that you're entitled to, and limiting your income, don't be shocked when you don't qualify for a mortgage, because there are real estate brokers, I know them, who make $200,000 a year who can't afford to buy a house. Because when they file their taxes, they take so many tax deductions that they're only showing an income of like $42,000. And they drive a car with $1,000 car payment. And the lender's like, how could we possibly give you a loan? Your car payment is more than what we could afford. You could afford as a house, because they're going to base it on what you're reporting to the federal government. So yes. Now, Mary asked, as a couple, do we use both incomes if both people are qualifying for the loan, if both people are applying? Yeah, you would.
Hey, Travis, so to sum it up, you said before we went into the math that debt to income ratio is just a comparison to how much debt, and I didn't hear the rest.
Versus the income you bring in.
Okay, versus income brought in. Thank you.
It's a way of a lender looking at a borrower and saying, yeah, we think you can afford this monthly payment. We think you're safe paying us back. Because the worst thing a lender could do is loan out so much money that the borrower could never afford the repayment. Does that make sense? You would just be putting yourself in a destined to fail situation.
Yeah.
And if somebody only makes $30,000 or $40,000 a year, you give them a loan where the monthly payment is $3,000. No, they don't have it. It's not going to work. By the way, I'm just going to point out something. This is not on the test, but here's my soapbox moment for y'all are getting into this industry, so you're going to be part of it. That's exactly what happened in 2007, folks. 2005, 2006, 2007. Routinely, those of us in this business who tried to have some sanity were going, what is going on? This person makes $50,000 a year and you just qualified them for a $700,000 house. How? Where's the payment coming from? How on earth? And guess what? It didn't work. Guess what happened to all of those notes?
They all went into foreclosure.
They all went into foreclosure because people couldn't pay them. So this debt to income ratio is a really important number. Okay. So
it's not important for the test, right?
Well, that last part's not important for the test, but the idea of a debt to income ratio is important for the test. Yes, just knowing the concept. Yes. So one of the very common fees that you're tested on, even though they've become less common in the real world to some extent, they're still common, but they're less common now because interest rates are already so low. A lender can offer a borrower the opportunity to essentially pick what interest rate the borrower would like to pay, which sounds weird because obviously if the borrower gets the choice, they're always going to choose a lower interest rate, I would think. Here's what you need to understand about that, though. That choice comes at a cost. It's, do you want to pay us now or do you want to pay us later? If you want to pay us now up front, we'll be glad to give you a lower interest rate so that you pay us less later over the course of the loan. Or you don't have to pay us anything now, but we will charge you a higher interest rate over the course of the loan, which means eventually you'll end up not only paying us, but paying us what?
Upfront?
More.
More. You'll end
More,
up paying more. The idea of discount points, folks, is pay me now and save money over the long run. But not a lot of people are currently interested in purchasing discount points because the amount paid up front is really expensive compared to what they see as a monthly benefit. But I need you to get in your brain what's actually happening here. This is a lender. So let's say Howard is borrowing money. Howard is going out and taking out a loan. And the bank's offered him a 4% interest rate. And Howard says to the bank, well, I was thinking more like 3.5%. And the bank says, no problem, Howard. We like you, my friend. We'll be glad to give you 3.5%. But here's the only catch, Howard. If you want 3.5%, and we can give you 3.5%, but if you want 3.5%, you're going to have to pay us a little something up front because we're going to lose a lot of interest over the life of that loan, Howard. I mean, you're borrowing this money for 30 years. And if you drop that rate down to 3.5%, you're going to save a lot of interest over the course of 30 years. So you're going to have to pay us just a little tiny something up front to get that lower rate. Does that make sense that that's the conversation that's happening here for discount?
Yeah.
Exactly.
Right? So the question is really going to become for Howard, what's the next logical question Howard's probably going to want to ask?
How much?
How much is the
How much?
point?
How much is a little bit, right? And not only how much, but two how muches. Number one, how much do you want me to pay? And number two, how much is that going to save me on my monthly payments? Does that make sense for everybody?
Uh-huh.
Essentially, here's what Howard is buying. He's buying lower monthly payments. His monthly payments are going to be lower because his interest rate's going to be lower, but he's having to pay money out of pocket up front to get those lower payments and that lower interest rate. Is everybody okay with that statement?
Mhm.
Yes.
Okay. So why do people do this? Well, some people recognize that they're going to save a lot more because they're going to be making a lower payment for 30 years. Well, you know, God, what's a little money out of my pocket right now? If you look at how much I'm going to save, even, I mean, think about it this way. Even if Howard's only going to save $100 a month, well, $100 a month times 12 months a year times 30 years, that's $36,000 Howard's going to save if he's just saving $100 a month. That's a lot of money, isn't it?
Mhm.
Yes.
Right? And so Howard may be looking at that thing going, damn, I can save $36,000 because my payment's going to be $100 cheaper. But that's only one question about how much. The other question is, what does he have to pay to get that
Right.
savings? How much does he have
Right.
to fork over up front to get those savings? Does that make sense for everybody?
Yes, sir.
Okay. And so why do people not buy discount points? Well, they figure out it's too expensive. And I'm not saying this is for everybody. I'm saying some people will do that math and say it makes sense for them. But some people will do the math and say, you know what? It doesn't make sense for me because I'm not. How about if Howard knows he's going to sell the property in 2 or 3 years? Does it make sense for him to pay a bunch of money up front when he's only going to be getting the lower payment for 2 or 3 years?
No.
No.
No, right?
This is for
Because,
down businesses.
because even if he's saving $100 a month times 12 months a year, but he's only going to keep the loan for 3 years, now instead of 36,000, he's only saving 3,600. And we haven't
Yeah.
talked yet about how much he would have to pay out of pocket because he's not going to get a rebate. Once you buy these discount points, you've paid this money. It's a non-refundable one-time, you know. So here's the thing, you should only really buy discount points if you're going to be in this for the long haul. People that buy discount points should be planning to keep that loan for a long time so that they actually get the savings. Does that make sense?
Mhm.
One of my young buyers had a really inexperienced lender, I believe, and Travis saved him like $3,000 because I didn't know what I was looking at. And they were charging him like $3,000 for discount points. And he's like, they're not giving him a lower interest rate. He's buying that.
Right, he's
interest rate,
buying the
so-
interest rate down, and you're looking at somebody who's buying a townhouse. It's their first house. How long do you think a first-time home buyer buying a townhouse is going to be in that home, folks?
5 years,
5
max.
years, yeah.
4 or 5 years. They don't need to be buying discount points. They need to save their money up front and then just make the higher payment for those 3 or 4 or 5 years, put the money that they would have paid up front somewhere else, making some money, and use it on down payment on house number 2. Does that make sense?
Well, and yeah, and the other thing is, I used to explain to people, look, you know, your loan's $350,000. 1 point is $3,500. $3,500 is refinishing the hardwood floors.
It's
But
it.
where do you want to spend the money, you know?
Seriously.
It's where you want to spend your money. So
Now,
let's talk
now a
about.
lender probably won't let you, you can't roll that into the mortgage. That's something you have to pay in cash.
That is
Yes.
correct. This is cash out of pocket. They don't, rolling it into the mortgage does them no good. They want their money. They want this money up front.
You can on a refinance, you just can't do it on a purchase.
Right. And so like, imagine Howard having to take a checkbook out and which kind of, this is the other thing about discount points, which I always sort of giggle at. You're charging a person a fee when they're borrowing money from you. Well, hell, they already need to borrow money and now you're taking money back from them. Isn't that like counterintuitive anyway?
Yeah.
Right?
Yes.
You know, like we're going to loan you $350,000, but you give us $3,500 to loan you $350.
Do I have options?
It's right. It's like it's completely counterintuitive. But if you're going to stay in the loan for a long time, it does make sense. They are non-refundable, and we're going to get to the how much do they cost in a second. But I want to make sure we understand the basic fundamentals of them. They are non-refundable. They are paid up front. So as soon as Howard takes out that loan, he owes the discount points. Day number 1, he doesn't even get to wait till he makes the first payment. Because remember, that first payment's going to be lower because of the discount points. So he's got to pay for the discount points in order to get that lower payment. Everybody with me?
Mm-hmm.
So on day of closing, he's paying for these discount points. It's going to be a closing cost of his. They are considered to be prepaid interest because the idea here is you're prepaying interest to save more interest down the road. Now, one of the things they may talk about is what does this do to the lender's yield? Yield is like, I think of it like crop yield, you know, like they're trying to make money here. If you're paying them money, folks, you are increasing their yield so that you're giving them a higher yield on the loan because they're making more money off of you because you're paying them a fee, right? So it increases the lender's yield on the loan. It does lower the borrower's interest rate, which of course also lowers what for the borrower? What's the big connection you need to make there? If the borrower's interest rate is lower, what's also going to be lower?
Monthly payment.
The payment.
Monthly payment's going to be lower, right? So the borrower is going to get a lower monthly payment. So how much does a discount point, singular, cost? Every one of them costs 1% of whatever amount is being borrowed. Whatever the loan amount is, once we decide how much Howard's borrowing, then we simply say, okay, if Howard wants to buy a discount point, and he may not just need to buy one, he might need to buy several. If Howard wants to buy one discount point, we're going to charge him 1% of the loan amount. So look at just a quick math example of that. If it's a $200,000 loan, every discount point Howard buys would cost how much money up front?
$2,000.
$2,000.
$2,000.
$2,000.
$2,000, right?
Right.
Let's say, remember I gave y'all, does anybody remember the two numbers I gave you? Howard goes and the lender offered him what rate?
4%.
4%,
4%, right? And Howard wants what?
3.5.
3.5.
Now
It
you're
cost
not
him
gonna
2
have to,
points.
you're not gonna
3.5.
you're not gonna have to know how to do this on the test, folks, but that's
Mhm.
probably 4 points to accomplish that right there. 4. How much does each one cost?
$2,000.
$2,000.
So how much would Howard have to pay to get that? Yes, Howard, we'll be glad to give you that 3.5% rate. All you gotta do, Howard, is write us a check for a tiny little sum of $8,000 on the day of closing, Howard, and you can have that 3.5% rate that you want so bad. That's discount points.
But the difference between a payment at 3.5 and a payment at 4 is probably not, depending on the loan amount, is probably not even $100 on a
Well,
loan.
we could actually do it because we could say 200,000 times 0.5%, because that's what he's saving, right? 0.5% divided by 12. Howard, let me tell you what your savings are, my friend. You are saving a whopping $83.33 a month by paying $8,000 up front. Doesn't that sound good to y'all?
Not
Depends.
at all.
How do you get the 8,000, Travis?
He would pay $8,000 for the discount points and save
For 30
Somebody-
years, yes.
$83 a month.
But how you get the 8,000 from? You multiply
Here's how
200,000 times.
here's how I got the 8,000. He wanted to buy the rate down from here to here, and I'm just telling you that's 4 points. You don't have to know how to figure that, but it's 4 points. The reason it's 4 points, it takes 8 points to move the rate a full percent. If he wanted to move that rate a full percent, it'd take 8 points. How much did he want to move the rate?
Half,
Half of a percent. So
Half.
what's half of 8?
4.
4.
Right? If he wanted to move it 1/4%, how many points would he need?
2.
2.
2, right? Because a quarter of 8 is 2. If he wanted to move the rate a full percent, he would need how many points?
8.
8, right?
So I just did a quick calculation. If he saved the $83 a month, he
Yep.
would break even. In other words, pay himself back the $8,000 it cost him to get the rate in 8 years.
It'd take him 8 years.
So if you're, even if he's in the property for 10, he's not going to earn, he's going to get $83 for 2 years.
Right, his savings is very minimal. And what could he have done with that $8,000 for that 8 years? Because he misses out on that, right?
Hot
He could have
tub.
bought furniture and refinished the hardwood floors.
Right. So does everybody see that these are probably not going to be popular with most buyers just because of the tremendous cost associated with them?
Mm-hmm.
Okay, so this is what you're going to be faced with on the test. This is an example of a test question. How much would be charged for discount points at closing to a borrower who's purchasing a $150,000 home with a 90% loan to value loan and purchasing 2 discount points? Now, let me go ahead and warn you what's going to be your nemesis here. People are going to want to jump the gun and go, oh, 2 discount points, that's 2%. Does everybody see where that came from? Because
Yep.
each point cost what?
1% of the loan amount.
1% of the loan amount. But here's what people are going to be tempted to do. Oh, 2% of $150,000. Is this borrower paying 2% of $150,000?
No.
No.
No, because they're not borrowing $150,000. It's
They
$150,000,
pay 10%.
but it's 2% of their loan amount. Does that make sense for everybody?
Mhm.
So the first thing we have to do when we're talking about discount points is figure out how much we're actually borrowing. And that's where that loan to value ratio comes in. So we're going to take the $150,000 purchase price first and multiply it times the 90%. Does everybody see why we do that? Because we need to figure out how much is being borrowed. Is everybody with me on that?
Mm-hmm.
Okay. So now that gives us $135,000 as a borrowed amount of money. Each discount point is going to cost 1% of that 135. Since they want 2 discount points, we can just say, okay, well, that's 2% of that 135. And if we do that math, that's where we come up with total discount points of $2,700. It's a $135,000 loan times 2%. So talk to me about that. How many of you feel okay with that? How many of you don't feel okay with that? Because that's what you would be asked on a test regarding discount points. How much is the charge going to be? How much is the borrower going to be charged for the discount points? And you're going to get practice with this, obviously, with, you know, as we do more of these questions, but are we okay right now? Anybody lost about that?
Yeah.
Okay, good. Very good. Very good. As we mentioned earlier, if they happen to, you will not have to do a math question at all with how much the rate changes, but you may see a multiple choice question about how much the rate changes. This has nothing to do with what the cost is for the discount points. This is what the benefit, there's a cost to discount points. There's a benefit to discount points. Which one do you think adds up faster, the cost or the benefit?
Cost.
The cost. In fact, for me, the way to remember this was the bank wants you to pay 8 times faster than they give you the benefit. They want you to pay a full 1% for each discount point, but they only want to give you the benefit at 1/8 of 1%. In other words, the rate is only going to drop by 1/8 of a percent. So if you, and which by the way happens to equal 0.125. So if you think about it, so Howard's loan, they offered him 4%. At 4%, he doesn't have to buy any points, 0 points. Does that make sense for everybody? Because he's taking the rate that they offered him.
Mm-hmm.
If he wants that rate to drop to 3.875, he needs to buy 1 point. Does that make sense for everybody? Because he's dropping the rate by that 0.125. Does that make sense for everybody?
Yep.
If he wants to buy a rate of 3.75%, he has to buy how many points?
2.
2 points. If he wants a rate of 3.625 or 3.6, that's right, 25%, he needs to buy 3 points, right?
Mm-hmm.
If he wanted the 3.5%, he needs to buy, not 3%, 3 points. He needs to buy 4 points, and so on and so forth. Could he theoretically buy this rate down as far as he wants to?
Yeah.
You know, depends on how much money he wants to spend out of pocket. But each one of those points is going to lower that rate by 0.125. Everybody okay with that?
Mhm.
Yes.
Mhm.
That's more just a memorization piece there.
You know, back in the day, points used to buy you a lot better buy down. The margins have gotten so small for lenders now. That's just amazing to me.
Yeah.
It used to be a half for an 1/8.
Oh, wow.
Yeah, it really is. It's amazing how little the benefit is at this point. Okay. Another example of a closing cost fee that lots of lenders will charge is something called an origination fee. Origination is the fancy word for paperwork. It's a paperwork fee.
Fee, it's a fee.
It's a fee for processing the loan. If you think about it, there's a lot of paperwork and there's a lot of processing involved with putting a loan in place. When a lender is charging an origination fee, they're basically saying, okay, you're going to pay us interest for the next 30 years, but we want you to pay us right now for the work we've done up to this point. We've done a lot of work in getting this loan ready for you. So here's the loan, but pay us this fee up front. Everybody okay with that statement?
Mm-hmm.
Now, just like discount points, origination fees are based on the amount borrowed. They will simply tell you in a test question, the origination fee is 1%. Well, is it 1% of the purchase price or 1% of the amount borrowed? What do you think?
Amount
Borrowed. Or the origination fee is 0.5%. Well, it would be 0.5% of the amount borrowed. So they will simply give you a number. So look at this as a test question. What would be the origination fee charged to a borrower who's purchasing a $515,000 home with an 85% loan to value ratio if the lender is charging a 1.5% origination fee. Well, we know that 1.5% origination is going to be 1.5% of what?
The borrower money
The
from
amount borrowed, the
loan.
loan
515.
amount, right?
515.
So the first thing we have to figure out is how much is actually being borrowed, because we're not going to pay 1.5% of 515. That number doesn't matter for loan purposes. That's the purchase price. What we have to do is tie the 85% and the 515 together to see what our loan amount is. Does everybody see what I mean by that?
Mm-hmm.
So when we take a
Yes.
look at that, when we combine those two things, when we say that we're only borrowing 85%, our loan amount is 437,750, and that's going to become the basis for calculating all of our loan fees, like origination fees and discount points. So that 437,750 right here times our 1.5% origination fee, that results in a fee amount of $6,566.25. And again, folks, that is paid out of pocket up front on the day of closing.
Can I just borrow the money?
Pay the fee.
But there is a reason that Travis is pointing this out, calculating the loan amount, because it is so common for test questions to be presented with the purchase price. And people
Yeah.
fall for it because they're reading fast.
For sure. So let me give you, I want you to, I don't have one in the slides here, but I want to do this. I want to give you one for you to work on your own for just a second, because I want to make sure you can do one. So let's say Travis is purchasing a home for $625,000 and obtaining, oops, can't spell, obtaining
Can't draw either.
an 80% loan to value loan at 4% annual interest for 15 years while purchasing 2 discount points and paying a 0.5% origination fee.
Wow.
How much is Travis charged? Oh, not charges, charged for discount and origination fees?
I have it ready.
Okay, there's your question. And I want you to take a couple minutes and do that. Okay, Travis is purchasing a home for $625,000 and obtaining an 80% loan to value loan at 4% annual interest for 15 years while purchasing 2 discount points and paying a 0.5% origination fee. How much is Travis charged for discount and origination fees? And keep in mind that Travis may have given you garbage information here that's way more than you need in order to answer this question, because they're going to do that to you on the test as well. I want to know the total charged for them, not as 2 separate numbers. I mean, if you calculate them as 2 separate numbers, which is fine, I want to know the total that's going to be charged on the closing statement for discount and origination fees. Think
This
about
is,
it.
this is where you sing the Jeopardy thing. Da, 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 da.
I could do that. I could do that.
You looking for the soundtrack?
All right, let's take a look at it. Let's talk about it here. First of all, does the 625 number matter all that much?
To calculate.
Just to calculate your loan amount.
Just to calculate the loan amount, but we're not going to pay the fees based on 625. Does everybody see that we're not paying the fees based on 625,
Yes.
right? Because we're paying the fees based on the amount borrowed. So step number one for me looks like 625 times 80%, because I need to know how much is going to be borrowed. Does that make sense for everybody?
Yeah.
Okay. So I come up with a loan amount of $500,000. Did everybody come up with that for your loan amount? $500,000.
Yep.
Okay.
Yeah.
So now, here's what I'm looking at based on that loan amount. I know I need 2 discount points, 2 points, and that's going to cost me 2% of the loan. Does that make sense for everybody?
Yep.
Okay. So I can say, well, we got a $500,000 loan times 2%. Sounds like about $10,000 for discount points to me. How about, how's everybody feel about that?
Yep.
Yes.
Yes.
And then they told me that my origination was going to be 0.5%. So I'm going to do the same $500,000 times
Mhm.
0.5%. Okay. What'd you come up with that? 2,500?
Yep.
Yep.
And if I'm totaling them together, the total charge at closing, $12,500.
Good.
$12,500. That'd be the total charge for discount points and origination fees at closing. Okay. So if you got that, you're in great shape here. If you didn't quite, don't fret. You're going to get an opportunity to practice with it, but you need to go back and put in your notes. Okay, I got to practice on calculating discount points and origination fees. Because overall, this is relatively simple math. And I think of the finance math, everybody should be able to get this question right of how much we're paying for discount points and origination fees. Okay. Can I clear this off? Because once I clear it, I can't go back to it because it's a whiteboard thing.
I'm good. Yeah.
All good?
Yep.
Okay, good. All right. So let's talk about some different loan types and what kinds of loans are out there, what kinds of loans are available to people. Everything we've talked about thus far in this section could apply to any type of loan. You could have discount points on any type of loan. You could have origination fees on any type of loan. Use debt to income ratios to qualify for any different type of loan. But now we want to talk about the different loan types that are available and why certain borrowers would qualify for this loan versus that loan. Lots of borrowers are going to qualify for all of these loans. But that's not a bad thing. That means they get to pick and choose which one they think is better for them. Okay. Mary, 500,000 times 0.5% does not equal 25,000. 500,000 times 5% equals 25,000. But if you type what you just wrote on the chat into your calculator, 500,000 times 0.5%, you should get 2,500. But don't be playing games with yourself and moving decimals and telling yourself you're typing that into your calculator when you're not really typing that into the calculator. Make sure you're typing it into the calculator just like that. 500,000 times 0.5% should be 2,500. And remember, when you hit the percent button, that's it. You're done. No further. That's always the rule of the percent button. Okay. So different types of loans. The most, I shouldn't say most common, because it's not the most common. The most desirable loan of all the loan types is something called a conventional loan. And even within conventional loans, we're going to talk about types of conventional loans that are more desirable. But overall, the conventional loan is generally, for most people, and these are not going to be always rules, they're going to be exceptions. There are going to be certain times when certain loans are better than others. But for general purposes, the conventional loan is going to be the gold standard for most people. The conventional loan is going to be what most people will aspire to be approved for when they start to work their way through the qualification process. Don't think of qualifying for loans as an all or nothing proposition. When you start to think of it that way, you start to get confused about why there are different types of loans. There are different types of loans, folks, because not everybody is going to qualify for all of them. Let's be clear. If somebody walks into a bank and they have an 830 credit score and they make $300,000 a year and they have no other debt, they're going to qualify for every type of loan. There's not going to be a loan they're denied for because they are qualified for any loan. But are there going to be other borrowers who maybe have some issues? Maybe this borrower doesn't have the best credit in the world. Maybe this borrower doesn't have much of a down payment. Maybe this borrower has other challenges. There are different loan types because there are different types of borrowers. But what every borrower is aspiring to when they apply for a loan is the conventional loan. Now, conventional has a definition that you need to memorize. I cannot stress enough, this is one of the few things that you can straight up memorize a definition and get the test question right. Don't miss this as a test question because it is a straight up definitional test question thing. Conventional loans, simply put, are loans that are not guaranteed by any government agency. They are loans that are, and so what do we mean by guaranteed? Guarantees do not help borrowers. Who do you think a guarantee or backing would help? Who would it make feel more at ease about the loan?
The lender.
The lender. Guarantees or backing are there to make the lender feel more comfortable making the loan. A conventional loan is a loan where no government agency is making the lender feel better about the loan. That sounds like a bad thing. It's actually a good thing. Guess why no government agency is stepping up to back these loans? What do anybody have any idea why that might be?
It's not needed.
It's not necessary. And I'm gonna fast forward a slide and I'll back up. It's not necessary because guess who gets conventional loans?
The best qualified buyers.
The most qualified buyers, the cream of the crop. They're not backed by the government because nobody cares. Nobody cares that these loans are backed by the government because these loans have been made to the best, most reliable cream of the crop borrowers. Those are your conventional borrowers. When we talk about loan guarantees, guarantees really only come into the picture when lenders are worried that the borrower might not pay. And even one step further, as we talked about earlier, how many promises are these borrowers actually making to the lender? Is it one promise or is it actually more than one promise?
Two promises.
Two promises, right? There's two promises being made here.
Mortgage and note.
There's the note, which is the promise to pay, but then there's the backup promise of collateral. Lenders really only want to see a guarantee when they're worried about both promises failing. When they're worried that, number one, this person might be at risk of not paying, and number two, the property might not sell for enough money to get us paid back. Does that make sense for everybody?
Mhm.
Because if the lender is very comfortable with either one of those two promises, number one, this borrower would never leave us high and dry, then we don't care about backing. If the lender is comfortable with promise number two, the property will sell for enough to easily pay off the mortgage amount, then the lender's not going to care about backing. But when the lender gets nervous about both of those things combined, they want to see some type of backing or some type of insurance against that eventual problem. Does that make sense for everybody?
Yeah.
In other words, you don't buy insurance because you think things are going to go well. You buy insurance. Why do you buy trip insurance? Not in case you have a great vacation. You buy trip insurance in case what?
It can't go.
Have
In
a
case
problem.
you can't go. You don't buy health insurance in case you're the healthiest person you know. Why do you buy health insurance?
If you get
In
sick.
case you get
In case
sick.
you get sick. You don't buy life insurance because you expect to live forever. You buy life insurance in case you what?
Die.
If you
Die.
Die. That's what insurance is. So why do you think some lenders in some situations are going to want to see insurance or a guarantee? They're worried the loan might what?
Oh, go unpaid.
Fail.
Default.
Default. They're worried the loan might fail. They're worried that the borrower may not pay the money back and the property won't satisfy the note. Does that make sense for everybody? Okay. So with conventional loans, because they are made to the most qualified borrowers, the borrowers who have the good credit and who have a high down payment, most of the time, conventional loans, what kind of backing do you think the lender is going to want to see? If you're already lending to the best possible
None.
borrowers, the
If
ones
you
who have the
have
best
backing.
credit and high down payment, what kind of backing or insurance do you think you're going to require that borrower to take out?
They don't
None.
need it.
Maybe none.
None. None at all. That's called an uninsured loan. And let me tell you, but before we even get there, why is uninsured important? Because guess who would have to pay for the insurance? It's not the lender that's going to pay for the insurance. Guess who has to pay for it?
The borrower.
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 Borrower does. So it's much better for a borrower to have their loan be uninsured because they don't want to pay for that mortgage insurance. Does that make sense for everybody?
Yep.
Okay. So when we talk about conventional loans, these are loans that are not only are they made to the highest qualified buyers, they don't have any backing at all from the federal government. They are usually less risky because we are lending to more qualified buyers, and hopefully those buyers have more of a down payment. The higher their down payment, the lower their loan to value ratio, the less risk there is in the loan. And there's actually a magic risk number. When we start looking at risk in these loans, there's a magic number where we look at it and you go, you know what? This is a very safe loan. This is a loan where we don't have to worry about much risk. Everybody kind of following where I'm headed with this? That
Yeah.
magic down payment amount, that magic amount where we step back and we go, you know what? That number right there, that's the number at which I'm comfortable that we don't need any insurance on this thing. That number is usually 20% down. 20% down is considered to be the magic amount for most lenders. Any borrower who's willing to put 20% or more down can get an uninsured loan. Now, remind me, why is that good for the borrower? I mean, it sounds like to me, you may as well have some insurance. I mean, why wouldn't you want to have insurance? I know it doesn't help me as the borrower. It only insures the lender. It helps the lender, but gosh, why wouldn't I want the lender to have insurance? Why does the borrower want to have an uninsured loan, folks?
Lowers your
Doesn't
payment.
have
They
to
don't have
pay
to
the
pay
mortgage.
interest rate.
Because they don't have to pay for the mortgage insurance. That's why the borrower wants an uninsured loan, because they don't want to pay for insurance that doesn't benefit them. How many of y'all want to sign up to pay for an insurance policy that doesn't do you any good?
No
Not us.
thanks.
Not me. No thanks. But that's what mortgage insurance really is. It's insurance that doesn't help the person who's paying for the insurance. So mortgage insurance, better known in most cases as private mortgage insurance, protects a conventional lender in the event that the property is foreclosed on. Now, here's something I want to point out to you. Mortgage insurance does not kick in as soon as you start missing payments. It's not protection that you won't pay. It's protection that you won't pay and the property also didn't pay. So when could a lender file a claim against private mortgage insurance? Not until we've all gone through the entire process and what has already happened.
Foreclosure.
Foreclosure. The only way you could actually get a claim against a mortgage insurance policy is if the property has already been foreclosed on. Because here's the thing, if the lender's owed $200,000 and the property sells for $300,000 at the foreclosure auction, how much is the mortgage insurance claim going to be for? And we'll say that again. The lender's owed $200,000, the property sells for $300,000. How much of a mortgage insurance claim are we going to have?
None.
200.
Zero.
They were paid.
Because
Oh.
the lender got how much of their money?
All
All of it.
All of
Oh.
it. Mortgage insurance is not there, folks, to make lenders better than whole. It's only there to pay in the event that they don't get their money. Does that make sense for everybody?
Yep.
So if the lender's owed 200, but the property brings 180 at the foreclosure sale, do we hope there's mortgage insurance in that case?
Yes.
Yes.
Yes, because that mortgage insurance would kick in, there would be a mortgage insurance claim, and the mortgage insurance would pay the $20,000 difference. Does that make sense for everybody? Now, who
Yes,
does that primarily benefit?
Lender.
The lender.
The lender, but could it also potentially benefit the borrower to some extent too?
Yeah,
Yes,
for a
because they're
deficiency
gonna close the
judgment.
loan.
Maybe no
Would it
general
keep them
lien.
from having one of those deficiency judgments following them around?
Mhm. Yes.
Better than that, yeah.
Because the lender got paid. Does that make sense for everybody?
And you don't have a loan.
And I know we're hounding on, the different claims and whatnot, but it took me a long time to realize that a conventional loan doesn't have to be, that they're not all uninsured.
Correct. Conventional loans
Long
might
time.
require mortgage insurance. I'm gonna back up a slide since Seth mentioned that because it's a really good point. A conventional loan is only uninsured if somebody puts down what percentage?
20%.
Less than 20%.
20%.
20% or more they put down. In other words, they're borrowing what percentage or less?
80.
80%.
80% or less. They're putting down 20% or more. They're borrowing 80% or less. Can you borrow more than 80% on a conventional loan, folks?
Yes.
Yes, and it drove me crazy.
Yes. It's still a conventional loan if you borrow more than 80%. But the lender's going to start sweating. Their palms get really sweaty when they lend you 90% of the property's value. How do you take away their sweaty palms so that they feel better about loaning you such a high percentage of the property's value?
You buy them some insurance.
You buy them insurance. That's the perfect way to say it. You, the borrower, buy insurance that covers the lender. And that's called private mortgage insurance. Does that make sense for everybody?
Mm-hmm.
Travis,
Yes.
when we got our home, we had the PMI, but we found out we had equity in the home. And although we did not have to pay the 20% down, the equity covered the ratio. Am I saying that correctly?
Well, So yes, it's the same thing. They're lending you no more than what percentage of the property's value?
20%.
20%.
You're
Flip it
lending
around.
80.
Oh, 80%, sorry.
20% is your portion. Theirs is they're not lending you more than what?
80%.
80%. And
Mhm.
if they feel comfortable that they're not lending you more than 80% of their property's value, they probably will not make you purchase what?
PMI.
PMI.
Okay, it's the same exact thing. Overall, lenders simply don't want to lend more than what percentage, and they get nervous at more than this percentage. What number?
80%.
Percent, which generally means the borrower would have to put at least what percentage down? Because remember, you think about that teeter-totter, which if
20%.
they don't want to lend more than 80, they want you to put at least what down?
20.
20. Well, you can still play with those numbers. You can only put 10% down and borrow 90%, but the lender gets nervous and they say, we'll only make you that loan under one condition: buy us some what?
Mortgage insurance.
Some insurance to cover us. So look at these charts here. This is just an example of 3 different loans on the same property at different loan to value ratios. Now, what you have across the middle of the screen here, that green line, that's 80% loan to value. Remember, that's the lender's comfort level right there. That doesn't mean the loan can't exceed that. It just means we're in an uncomfortable area when the loan exceeds that. Does that make sense for everybody?
Mhm.
So if you look at the first one, is the lender uncomfortable at all in this loan over here?
No.
No.
In fact, we're not even close to uncomfortable for the lender here, because they've only loaned 50% of what they believe is the property's value. Does that make sense for everybody?
Mhm.
Yes.
And when they've only loaned 50% of the property's value, they feel very comfortable that even if you don't make the monthly payments, they could go through with what process and easily get their money.
Foreclosure.
Foreclosure. Lender looks at this and goes, folks, here's the thing. I'm just going to point out something to you because you don't like to think of it this way, but you need to think of it this way. You need to think of it this way. Could somebody walk into a bank tomorrow who wants to buy $1 million home at 50% loan to value and have a 400 credit score and probably still get the loan?
Probably, yeah.
Yes.
Yes. And I'll tell you why. Because the lender doesn't care if you ever pay. They know they're going to get their money even if they have to do what?
Foreclose.
Foreclose, because you're only borrowing half of the value of the property. If you've got 500 grand to put down on $1 million purchase, they really don't care what your credit score looks like, because they know that they're going to get their money even if they have to foreclose. Does that make sense for everybody?
Mm-hmm.
Yes.
It's a very comfortable range for the lender. How about the middle one though? Are they starting to get nervous here at the little and the one in the middle?
Yeah.
Yes.
Yes. This is the absolute top of the tolerance for nervousness here for the lender. You have maxed them out as far as their nerves go here. They will let you borrow this and no more without buying what? What are they not making you buy here still?
PMI.
Mortgage insurance.
No mortgage insurance, no PMI. But here's the thing, if you borrowed $1 more, are they going to make you buy mortgage insurance?
Yes, sir.
Yes, this is it. This is max. No more than this. Thou shalt not pass this line right here without buying what?
Mortgage insurance.
Mortgage insurance. So listen, folks, this is a very real world thing. This is how lenders will tell buyers, well, we can lend you up to this amount without you buying what?
Private mortgage insurance.
Mortgage insurance. Is everybody with me on that?
Mhm.
Uh-huh.
So let's apply this to a real transaction. If I go to the bank and let's say we're buying a property for $400,000. The lender would simply say, okay, well, we can lend you up to what number? 80% of that, right?
80%. Mm-hmm.
So what they would basically be saying is we'll lend you $320,000 with no PMI. Does that make sense for everybody?
Mm-hmm.
But if you want to borrow 325, you can, but you're going to have to buy what?
PMI.
Mortgage
PMI.
insurance.
Mortgage
Has
insurance.
anybody got a $5 bill?
You're going to have to buy mortgage insurance if you squeak over that line. Is everybody with me on that?
Yeah.
Mhm.
Mm-hmm.
Now, here's something I don't want you to miss this conclusion here. These are all still conventional loans. This is conventional.
Uh-huh.
This is conventional. This is conventional. Because none of these are guaranteed by who?
The
The
government.
government.
The government. 2 of them are not guaranteed at all. 1 of them is guaranteed, but it's still not guaranteed by the government. This one over here, no guarantee. This one over here, no guarantee. How about this one over here on the right?
Yes.
Yes.
This one is guaranteed by PMI. Does that make sense for everybody?
Mhm.
You'd have to buy PMI.
The borrower has no choice. The lender is literally saying, sure, but this part, that's too much risk for us to stomach without a what?
Got an insurance policy?
We
Guarantee.
need a
Policy
guarantee.
insurance.
We
Yeah,
need insurance. That's too much risk. You have exceeded our tolerance for risk without a guarantee. Does that make sense for everybody?
Mhm.
Yes.
But now, and this is where you're going to screw it up if you're not really paying close attention to the next thing I'm about to say.
I ain't gonna screw it up.
That guarantee, folks, does not cover that entire loan. Did I circle the entire loan in the black circle?
Nope.
No, that mortgage
Just the portion.
insurance policy does not cover the full loan. On the test, they are going to put an answer choice that says so-and-so loan is fully guaranteed. And I want you to hear one vivid word in your mind when you see that on the test. Bullshit. None of them are fully guaranteed. No loan is ever fully guaranteed. No loan of any type is fully guaranteed because the guarantee only kicks in at what magic loan to value ratio, folks?
80%.
80%.
80%.
So now here's a magic question. If we are doing a 95% loan to value loan, how much of this is in the protected zone here? How much are we actually having to insure?
20%.
Not 20, because we're not borrowing
10.
100%.
15%.
15.
15%.
So basically, when you're thinking about PMI, take 80% as your base, your zero at that point, then count up from there.
Right. So if we were at 81, we'd have to buy insurance on 1%. If we were at 82, we'd have to buy insurance on 2%. If we were at 83, we'd have to buy insurance on 3%. Everybody sees a trend here?
Mhm.
And we're just going to keep counting all the way until we get to, in this case, it's 95. So how many times did we go above 80? 15%. Does that make sense for everybody?
Mhm.
Oh, to
And,
get to 95. Gotcha.
and that's the part that's insured. And that's going to be a test question for
Absolutely.
That's for
Yeah.
sure a test question. No doubt about it. And people miss it all the time.
Not me.
All the time. Okay. So remember, the loan is not fully insured. The private mortgage insurance only kicks in above 80% and starts insuring from there. So I just want to give you this question. I'm gonna go back to this slide here. If that was an 85% loan to value loan, how much insurance would we be buying? Insurance on what percent of the value?
5%.
5%. If this was a 90% loan to value loan, we would be buying insurance on what?
10%.
10%.
10%. Does everybody see that? Right?
Yes.
If this
Uh-huh.
was a 92% value loan, we'd be buying in mortgage insurance on 12%.
12%. Okay.
And now I saw the question, Tyler asked, does it get more expensive as the percent it covers goes up? Yes, and let me tell you why. If you went to the doctor and you were getting checked for health insurance and you smoked 3 cigarettes a day, they would probably say, well, your insurance is going to be more expensive because you smoke. But if you smoked 12 packs a day, your insurance would probably be more expensive still because the risk
More
is,
risk.
the risk is even higher. Does that make sense for everybody?
Mm-hmm.
Yeah.
The answer to the question of does the mortgage insurance get more expensive as you go up there? Yes, dramatically more expensive. Somebody who's getting an 85% loan to value loan, folks, the mortgage insurance is going to be much cheaper than it would be somebody who's getting a 90% loan to value loan. Even though that doesn't sound like much of a difference in the down payments, the difference in the risk is tremendous because you go from insuring 5% to insuring 10%. Does that make sense for everybody?
Mm-hmm.
Okay. And that covers conventional loans. Just a reminder, conventional simply means that it is not backed by the federal government.
It's
And conventional can come in 2 varieties, either uninsured conventional loans or insured conventional loans. Uninsured conventional loans simply mean there is no mortgage insurance at all of any type. It also means the person did not borrow more than what maximum loan to value?
80%.
80%.
80%.
Anything above that that's conventional means the loan is insured, but not insured by who?
The government.
The
The
government.
government. It's going to be insured by a private insurance company. That's why we call it private mortgage insurance. And the private mortgage insurance is going to kick in at any amount above 80%. Now, this is the last note I need to give you about mortgage insurance, and I don't have it on a slide, so I just want you to clock in with me here for a second. And I'm going to go back to this picture. I'm going to erase my notes here and take a look at this picture. Okay, get all this stuff out of the way so we can talk about this. If you look at the one on the far right, folks, that 95% loan to value, we all agree that's going to require mortgage insurance, correct?
Correct.
Here's my question for you, and it's the last thing I'm going to leave you with today.
Mhm.
Eventually, is that loan going to become this loan as the balance is paid down and or as the value of the property goes up?
Yep.
Yes.
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 Yes. And folks, here's the nice thing about private mortgage insurance, if there is a nice thing about it. When the loan on the right becomes the loan on the middle, guess what also changes?
You're
Mortgage
paying.
insurance
PMI.
drops off.
Drops
The
off.
mortgage
Drops off.
insurance goes away. There's no risk there anymore. There's no need for the insurance anymore. It's sort of like your insurance company tells you, you're fat, so we're going to charge you more for your insurance. But as soon as you lose some weight, come back and we'll drop your rate down. Does that make sense for everybody?
Yeah.
Yes.
Because you're less risk now. And that's exactly what happens with private mortgage insurance. It goes away once the person gets below 80% loan to value. So that is what Taj was actually asking about just a second ago. She said that they took out a loan and they ended up not having to pay the PMI because they were basically able to prove immediately that they had enough equity that the PMI was not necessary. Does that make sense for everybody?
Uh-huh.
Mhm.
Mm-hmm.
And you can do that as a borrower. If you go into one of these things, even if you borrow 95% and 2 months later, property values of you around you have rocketed up. If you're willing to pay for an appraisal and file, an appeal, you can appeal to your mortgage company and say, hey, basically, I have 20% equity. I shouldn't be buying insurance for you anymore.
Yep. I've known people.
Travis, I thought you had to pay the balance down to 80%, not that the value could go up.
It can be both. It can be both most of the time.
Ah.
Yeah, with conventional loans, as
That's
long as you.
interesting.
Now, they generally will not let you get away with strict 80% when you're proving it that way. They might make you do 78 or something like that, but they're never going to test you on it like that. They're just going to
Okay.
test you on the idea that it can go away.
All right, got ya.
Yep. Everybody good with that?
Yes.
That is a good stopping point for today.